It's been good. Okay, you started, so people are gonna be coming in.
I like your cap,
Thanks.
the polo cap.
hmm I'm a huge cap guy.
Yeah, I should start wearing it because I'm losing all my hair.
Nobody would know.
Um, all right, so let's see. We're about 2 minutes before. I
We
guess
have a hundred.
when I
Go
don't
ahead.
when I don't start my screen sharing, I see everybody, right? And then when I start screen sharing, I just see a couple. Is that how it works?
Well, we're in webinar, so you're not gonna see anyone.
Are you able? Yeah. So when you start, I'll see everybody, or
No, so you already hit started. So everyone is here. Everyone can see and hear you, but you won't see them because this is a webinar.
I see. I see.
Yeah.
All right. I'm still obviously getting used to this, guys. I'm not the biggest technology guys, as you can tell. So, hey to everybody. Got 127 participants so far. So, great turnout. Um,
We have people from all over. I've seen Brian from UK. Welcome, Brian. And Michael from Malta. We have
so,
many
yeah, I
from
usually give a shout out, but I'd spend, all day just saying hi to folks. So, yeah, it's
yeah.
just fantastic to see the turnout. Got Rob from Amsterdam, Lawrence from Holland. John, thank you for your sentiments. So we've got some repeat offenders. People have been on prior webinars. Glad to have you guys back. I don't know. I get tired of hearing my voice. I don't know how you guys don't. So,
Brandon, I
all right. So, welcome one and all. I guess it's right on the dot here. Should I go ahead and share my screen, Dwight?
Yes, you can go ahead. I think we're on time. Yep.
Okay, one and all. Nice to have you here. I'll just maybe give this another 30 seconds and then get started. So we still have a lot of people piling in here, 164 thus far. So
hmm
fantastic turnout. Still got people coming in. So I'll give this, another minute and then I'll get started, Dwight.
Yeah, sure. Because
Oh,
yeah,
Emil
people are
says,
still
thank
coming in.
you to watch your live session. So Emil, thank you. We've got Wayne from Sydney, Australia at 6:30 a.m. there. So good on you, mate. I know a ton of people. I probably know more people in Sydney than I know anywhere in the world. I'm an ex-South African. You may not be able to hear from my accent, but a lot of my South African compatriots went to Australia. Some of my best friends live there. So I'm familiar with your time zones.
Yeah, so now we're up to 183, so people are still coming in.
185. So,
All
all
right,
right, I think
folks, we're gonna sorry, Mark, we're gonna ask that people use the Q&A box rather than the chat box to ask questions, just so it's a little more streamlined. You can always make comments in the chat, but reserve the questions for Q&A.
all right. So we're bolting towards 200 participants. So I'll give it till that time. Just give it a few more minutes and then we'll get started. Hey, Annette from SoCal, and that's been part of my groups, Master Pattern Trader and others for a long time. So good to see you. Hope everything is okay in SoCal. I know there's a drought there and many other things going on. So, all right, we're over 200 participants now. So I think I'm just going to get started, and then people can just incrementally wade in. So welcome one and all to this live 4-day event where I'm going to go through some of my trade execution methodology under real-time market conditions. So this is not hypothetical. I've subtitled this little get together, how to capitalize on monster moves in the markets and avoid the market traps. And it's probably the second that's most important. The market lays all kinds of traps, and this is where we do in our time and emotions. And, so I'll talk a good deal about that. My name again is Mark Chazen, the pattern trader. For those of you who don't know me, maybe I'll just give you a quick background. Before I do, you might see this weird contraption behind my head, and I got to get rid of that. I had surgery a month or so ago, and on my foot, and it's sometimes very hard for me to get up and around. So I use this bar, behind me in my office to kind of help me get up and out. So that's why, there's no strippers going up and down this pole. It's just it's a medical device. So I just want to kind of give you a heads up. I know it looks odd, and then I got a bed, sitting here. So this is, kind of a makeshift bedroom downstairs now for me. But no worries. I'm, hopefully on the mend, and it's just taken a long time. So a little bit about myself. I began trading more years and decades ago than I care to remember or acknowledge. They go by so fast now. I was, about 19, 20 years old. I was going to one of the best business schools in the country, University of Southern California, USC, out in Southern California. They used to call the acronym for USC the University of Spoiled Children, because it was a private university and what have you. It's probably the case, but hopefully I outgrew that phase. But I was going to USC Business School, one of the best business schools in the country, being taught all kinds of business classes. One of my favorite classes was an investment course by this fellow named Ken Treffs, who's probably passed on by now. He was in his late 80s when he was given the class. He was a multimillionaire, and he just loved to give back and teach. And I think maybe that's where I got that from, and that's why I started the pattern trader. But anyhow, in Ken's class, he really taught investments from what we call a fundamental standpoint. So he would, always say to us, observe the movies you go to, observe the products you like, observe the restaurants you go to, see who the companies are that are behind these things. And if you like it and it's popular, it's a good chance, other people will, and it'll be a good investment. And so from that standpoint, if we like something, then, you break it down, you look at a company from a price earnings, a sales inventory, you look at the management, you look at what are called fundamental information to make an informed decision about an investment going forward. This is what Warren Buffett does. So, there's a lot of people who obviously follow that way of trading. But right around the time I was going to USC, my dad was doing business with this investment banker by the name of Graham Loving. It's a name you couldn't make up. He was really just a character out of a movie. He wore an eye patch over his eye. Very, very smart guy, very idiosyncratic guy, kind of rarely spoke. And when he did, it was very profound. And my dad was kind of using his company to raise money for a drive-through animal park called Lion Country Safari. And then Graham would come over to dinners very frequently and talk about things. And, I learned that he was on the side actively trading the commodities futures markets. Now, this was in the late 1970s. And I don't know if any of you remember back that far, or even from your history books, but it was one of the most unique times in investment, history. That was the time where inflation went to the highest it ever went to in the United States. And the central bank, this guy named Volcker, moved interest rates up to 21%, if you can imagine that. I mean, last year, interest rates was zero. So can you imagine a world with 21% interest rates? Anyhow, this was the first time that gold ran to $1,000. Silver was at 50 bucks, pork belly, soybeans, everything was going crazy. And Graham was trading these markets and making a fortune in them. And then it wasn't, the amount of money he was making, that piqued my curiosity. It was also how he was doing it. So now he was trading about 10 or 15 of the most exotic markets under the planet at the same time: cocoa, live hogs, wheat, corn, soy meal, gold, silver, and it's like, how could you analyze the fundamentals of any one of those markets, and then come up with never mind 15 at the same time? So he was looking at all of these markets from a price and movement standpoint. He didn't really care, about the export, ratios out of Ghana for cocoa. He didn't care about a freeze in Florida to study, the prospects for orange juice. He simply looked at the price movement. And when we analyze price, we call that technical analysis. It's the analysis of just price itself. And there's many ways to do that. People look at candlesticks, people look at moving averages, all kinds of that is called technical analysis. And so it was from those early learnings from Graham Loving. Graham would just get out a simple piece of graph paper. So this was way before the internet, way before fancy charting services. So he would go down to the corner drugstore, get a piece of graph paper and just draw an X and Y axis for price and time. And, for 3 weeks, so he was trading the futures contracts. So futures contracts goes off the boards every 3 months. So before they did, he would just chart for 3 weeks the movement of cocoa and what have you. And over time, the line would be going up or it'd be going down. And he said to me, Mark, all I want to do is buy a market that's going up and sell a market that's going down. And to my 6-year-old brain, that just intuitively made so much sense to me. And so it was from, my early introduction with Graham that I went on to really kind of get involved in, the study of technical analysis, chart patterns, price action. And this is what I've been doing for decades and decades. And on balance, I was really successful from the get-go. And that was perhaps the worst thing, that could happen to you. It's like kind of being successful at a casino. You think you got, the world by the what, and builds this arrogance and hubris. And I learned very quickly that I certainly didn't have all the answers. And it's taken me a long time to kind of build this mousetrap where I, or this thing where, I've got a 4-step layered approach. One builds on the other to get you closer and closer to the bullseye of a, high reward, low risk trade setup. And, what I've also learned is that, I used to study, these massive 800-page books of all the technical analysis masters and what have you. I'd immerse myself. I would see a chart pattern and I go, well, this is what I saw in the textbook and this is what it looks like. And then I would go to town and then I would lose all my money. And it took me like decades and decades to kind of figure out the nuance. And this is why I say, avoid the market traps, because the market sets up all kinds of patterns. We look for double tops, triple tops, inverted head and shoulders. We see those all the time. And it's kind of sorting out which ones are the real ones and which ones are the traps that, I think, is where my real strategic advantage is. So over the next couple of days I'm going to spend together, we're just going to go into the market. I'm going to show you in real time what I do, how I trade the market, good, bad, or indifferent. And, I'll take your questions. So, just so you guys understand, I started the Pattern Trader about 5 years ago. My marketing partner, Peter, begged me to get into this business for about 3 years prior to that. And for 3 years, I kind of said, look, this is not a good idea. Trading is a loner sport. You really got to, blot out all of the distraction. And I thought, I didn't know how I would function, if I had the pressure of having hundreds of people, thousands of people following me, because I know things don't go perfectly most of the time. And I understand that trading's a process. I know what risk to it, but I didn't know how I would, be able to bear that thing. And then finally he said, I kind of started hanging around on certain webinars, seeing what other people did. And I realized there was so much BS out there. There was so much fraud. There was so much misrepresentation. People would show you track records growing to the sky based on these BS, MyFX book accounts, where if you really dug into it, you saw that the average take profit was like 2 pips or 4 pips. And you just know that that's not real. So I just thought I kind of had a duty to, I feel like I've solved certain components of the market, and I thought I had something to say and something to share. And that's why I started the Pattern Trader. But just so you understand me and my motivations is that I'm a trader first. I love trading. I've traded the markets for 4 decades. They're always different. They're always challenging your assumptions. And to me, it's kind of gone beyond making or losing money. And that's also been part of my growth and evolution is that I look at the purity of the setup. Is the setup true? Is it still true or is it not? And so, if it's not happening, I dump, losses very quickly. And if it is happening, I keep the winners. And so I'm going to show you over the next 4 or 5 days a little bit of my methodology and an insight into my process as I look at the markets, because we'll be looking at things under real live market conditions. So inevitably on these webinars, I always have people come on and say, you're a fraud, you never show your real account. And yet I'm doing things under real-time market conditions. This is not a taped recording. This is not something that was pre-recorded 3 months ago. And I can say, wow, I did this. So anyhow, what I'm going to do now is just kind of share with you a couple of trades that I've done recently, why I did them, what have you. Share with you perhaps some of my thoughts of certain setups that I'm seeing now. We'll have questions and answer, and we'll just do this over, 3 or 4 days. At some point, I'm going to ask you to kind of share with me, based on what you think, my approach is, what, might be good moves, and we can all analyze that together. So, I'm just going to quickly go through. This was my email just yesterday. So on Sunday, the 13th, 1:00 p.m., I sent out, very lengthy email to our members with the suggestion to buy BYND, Beyond Meat. So I show everything that I'm, looking at on the chart. I'll blow up BYND in a moment. And the idea was to buy it at, 150 on a buy stop with a stop loss at 144. And here's my take profit. We always get into a lengthy discussion about placement of stop loss and take profits. And, I'll just say that it's an art. It's not a science. Very often I'll place my take profit at an arbitrary distance away where I don't expect that take profit to be hit the next day. I mean, if this went up $31 and hit me today, I would say, thank you very much. But really what I want to do is, I set up my trade and then I want to see how the market responds to my setup. Is the market going in the direction I anticipate? What is the price action? And then if it does get closer and closer to this 180, I would then probably move my take profit even higher and higher. I'm not going to stop, the market from making me more money if it looks like, I'm on the right track. So I kind of set my parameters wide. I give the markets a little room to move, and then either I'm going to, win or lose on that. And if I'm winning, then I'll move my stop loss and take profit, concurrent with that. So these are, my positions that I came. Also yesterday, I put out a buy order on Tesla. So you can see these are the positions I had on today. I had 11,000 shares of BYND worth 1.6 million. I bought, at an average price of around 149, 150. And you can see that was my profits today. And then I also had 3,000 shares of Tesla worth about 1.8 million. So I take, these bets, and it may look like crazy, bets. I'm not risking $3 million on a bet. I have very, in my mind, I know exactly what my risk reward parameters are. And with BYND, I think my risk is very small for a very big outcome. Now, I took a huge bet on BYND a couple of weeks ago. This was my email on Tuesday, May 25th. It was a buy stop in BYND at 120.5. And I'll put up a real-time chart of BYND in a moment to show you what my thinking is recently. And I said it in my analysis, I said for the past several months, even when BYND was at $200, I said that BYND was going to crash below the neckline of 113, which is this blue line here. And it did. It went from $200 there and crashed all the way to 113. And all the way at the top here, I was predicting that. I said, well, that eventuality came to pass. However, following the crash through the neckline, BYND has taken a U-turn and it put on a rounding bottom. And then there was a series of, risk reward trade parameters here that I saw that, I got so excited that I literally loaded up the boat. And it looks like, again, I'm putting on these monster bets. I'm making these reckless kind of, crazy bets. But to me, I'll show you why I thought the risk was so low for, a great reward. So I started, again, buying Beyond Meat stock around 120. And then I also leveraged that bet by buying call options. So a call option basically is a leverage way to bet on the upside. So you can see at the time BYND was trading around 123 in the market. I bought the 125 and the 126 call options that expired just about 4 days after I was buying it. So I was buying these on a Tuesday, and by the following Friday, they would have expired worthless if they had not gone through the strike. Now, I started buying these around $1. You can see that I was up 249% just the following day. So I bought both of these things, in the low $1 area, and I was up, 200% respectively just a day later. You can see I also, in a separate account, bought 277 of the May 125 calls. So when the stock was trading at 123, I paid about $1 for the right to buy it at 125. And again, if it closed at 124.99 by the end of the week, I would have lost all of my money. So you can see I plunked down 35 grand. And by the end of the first day, I'd made $50,000. I was up 141%, just in the first day after I bought these calls. Now, concurrently, I also bought the stock. I bought 5,000 shares at 120. It was trading about 127, and I was making about 20 grand on the stock at the time. Fast forward just one day later, the stock shot up from 126 to 134.64, and my $19,000 gain shot to 58,000 on the stock. And remember, these call options I was buying at $1, they shot to $9.50. So the $35,000 that I placed down had increased in value $227,000. And then one day later, they'd shot up even more. So remember, I was buying these at $1, and they were trading at now $15. I was buying the stock at 120. It was trading at 139.5, and I was making close to $500,000 just on those two positions. Now I loaded up on another account and did the same thing, and you can see that the options that I bought for a little over $1 were close to $19. I bailed out of these options around $23. So the options I was buying at 1 went to 23. And you can see at that day, I was up 567% on that bet and 704% on that bet, and made over 600 grand. So cumulatively, between my stock and my options bet in these two accounts, I made $1.2 million in 3 days. And I shit you not. I know it sounds incredible, but there you have it. This is not a demo account. These weren't just plucked out of, I didn't have my graphics team put together these graphics. These are from my personal trading accounts, and these are true numbers. And I'm just trying to give you a sense for possibilities. So I just looked at a price chart. I saw the same thing that everybody else did. And I just had a vision of where this thing was going to go based on the price chart. And Roxy says it shows you need to make money to make money. And I just want to address that. That is absolutely not true, Roxy. I started out with the donut not too many years ago, okay, and built it up very quickly, showing you the ideas that I'm showing you here. And that is not true. You can start up with a very little. So these options that I bought for $1.50, it's based on 100 shares. So that means if you pay $1.50 times 100 shares, that's $150. So if you bought one of these calls for $150, you would have then had $1,500, right? So 10% I'm sorry, 1,000% you would have made on your $150 in 2 days. So, you can start with very little. It's just like anything else. Steve Jobs, Elon Musk, they started out with an idea. And if you know what you're doing, you can ramp that idea very quickly. So this is not for me to show you, hey, how much money I'm trading, this and that. This is, forget how much. Just remember that this went from $1 to $15.50 in 2 days. Forget the size of the market value. So it's not where you end up. It's where you start. A journey starts with a single step. So it's absolutely, and I'm going to show you how to use a risk calculator that you don't have to take huge bets, that you can take a 1% risk on a market and over time build, a huge amount by taking calculated, bets in the market. Now this looks crazy. It looks like I was, risking a lot of money. It looks like I placed a lot of money. But to me, the risk reward was, again, I've done like a half a dozen trades this year where I felt like the risk reward was so favorable. I felt like there was almost no risk at the time I was placing these trades for an unbelievable reward. I'll just show you one more and then I'll go back and show you that chart. But you can see, so eventually these options that I bought for $1.50 went to $21.50. And the stock that I bought at 120 went to 145 in 3 days. And I'll show you the chart in just a moment. In fact, why don't I just do that? Let me just kind of back up. I'll show you why I did the trades I did yesterday as well as today in BYND. Now, I also want to just quickly say that a lot of you may not have access to trade in the US stock market. You may not want to trade the US stock market. Everything I'm showing you, it doesn't matter if this, all I'm looking at is price. I'm looking at price action and price patterns. And I don't care if these price patterns and price action occurs in the euro yen, the corn chart, natural gas, gold. So what I'm trying to get across in these little webinar series is how to evaluate a market purely based on its price action. And you can use this trading methodology to trade whatever market you choose. So just because you don't trade BYND or just because you don't trade the US stock market, you shouldn't lose interest because you can apply, this, I will trade any market that you show me. In fact, I would recommend that the best way to be objective is to completely just scratch out. So if I just place this chart in front of you and you didn't know what it was, this could be the euro yen, this could be corn, and then all of a sudden it doesn't matter. Because if I told you this is a gold chart, all of a sudden you would have certain emotional connections with gold. You won in it before, you lost in it before, the Federal Reserve is doing something now, you would make some connection. But if you're completely objective and this is all I put in front of you, and this is how you should trade. But the thing is, this is how most people don't trade. So 90% of people are losing their money trading, certainly in the FX markets, very, very quickly. And so the question is, if everyone's doing the same thing, why is everyone losing? Because everyone's losing, using moving averages. They're using some kind of short-term chart, some 15-minute, 1-hour chart with some Bollinger Band crossover, what have you. What you'll notice on this chart is that there's no volume. There's no moving averages. There's no Bollinger Bands. There's nothing on this chart but price and time. And from this picture, I have literally made millions of dollars from everything you're seeing right here. So now, just to put this into perspective, I was actually very bearish and have been very bearish on Beyond Meat for quite some time. So when I evaluate a chart, and this one, is probably a good example and a bad example, because when I open up a chart, the first thing I want to say is, what is this thing doing? Is it an up market? Is it a down market? Or is it a sideways market? And basically, you would have to say that this is largely a sideways market. So ordinarily, if this was the euro pound or some of these things that just get locked into or the Australian versus the New Zealand dollars, I just abandon those. I just leave those. I want to make money going up, I want to make money going down. But if a market's just doing this, I stay out of those. I'm not looking to fight it out with my broker. I'm not looking to take, 20 pips out of a trade or 7 pips. I'm looking to take a piece of the middle out of a trade. Something like this. When I see a move, I want to take a piece of the middle of something like this. And so ordinarily, this would not be, a trade that I would look at. So the way I kind of, first I open something up and I say, what is this thing doing? Is it an uptrend, a downtrend, or is it going sideways? Well, it basically looks like it's going sideways, but to my mind, it's really changing direction. So, you always hear the saying, you can't pick tops and you can't pick bottoms. The market goes up and then it goes down. Market goes down, then it goes up. And you can't really pick those turning points. Well, I say bollocks to that. And that's, I think, where my strategic advantage is, because when a market goes higher and it turns, before it turns, it kind of shows you something. It shows you a pattern that looks like maybe an inverted head and shoulders. An inverted head and shoulders is just, what it sounds like. It looks like an upside down, or so it looks like the left side of a man or woman's shoulder. The peak is the head, and here's the right shoulder. And so that is a price pattern that indicates a reversal in the market. So leading up to this price pattern, there's an up market. Then if we see something like this, it means that the market's going to reverse. And if the market is going to reverse, it's going to be an opposite of an uptrend. It's going to be in a downtrend. So before the markets turn, they put on these price patterns. And it all looks very, quick and sudden, and the market reacts from one thing to the other. But frankly, another reversal pattern is a double top, where it just looks like the letter M, and then after the thing tops, it goes in the opposite direction. Now, when I first looked at this chart here, this very much looked like an M top. Now, these peaks don't have to be in the same area. You can see one was lower than the other, but when I saw this, I surmised that the market was going to go lower. And for a bit of time after it broke, it did. But this is where my real education, has taken decades to evolve, because I would see these patterns, in the market, straight from a textbook. And I would say, this is definitely going lower, like that. And I would, load up. And then when it kind of went against me, I'd get obstinate and I would sell more on the belief that it was going to go higher, and then basically get wiped out when it did that. So what I've learned is that the market shows you patterns, but then you've got to observe how the market plays within the patterns. So sometimes it's not only what a market is doing, but also what it's not doing. Now, that's a very nuanced sentence, and it may take a little while to settle in. And I realize that a lot of you are at different junctures. Some of you don't even know what a pattern is. Someone has never traded before. So I'm talking to a broad audience, and I recognize a lot of what I say, I might be assuming a lot. And so I apologize ahead of time, but let me just try and flesh it out and show you what I'm saying. So in here was another double top. Market went to a high, backed off the high, went to this peak, and formed this M top. Now, again, it's asymmetric. One peak is much lower than the other, but I think we can all agree that when we look back at this thing, it looks like the letter M. So this is a reversal top. And when I saw this, this indicated to me that we were going to go lower. So even at this juncture, if you see these things, you can make an awful lot of money by just, getting short right here, where it breaks this neckline. A neckline is simply a line that, runs through the entire pattern. So at that juncture, I surmised we were going to go a lot lower. And it did. In fact, you saw in my earlier email, even when the market was at $200, I said that we had to come back to this neckline. And you can't see it in this chart, but it hit this line many more times in the past. And again, I'm not going to get into it, but when you hit a line so many times, you usually retreat to it. So even at this juncture, I thought we had to come back here. And we did. But here's the thing, and this was what was the catalyst for me putting on such a big trade and getting so excited. It was by virtue of what the market wasn't doing as much as what it was doing. And so let me try and explain this. So now you had a huge series of very bearish price patterns over a long period of time, sitting on top of this line. Really, all of this price was sitting on top of this line. And based on that, when this thing eventually cracked, this is what should have happened. Yet when I say bearish, that means prices are going to decline once the pattern has been confirmed. So you can see this whole rounding top was confirmed here. And once it was confirmed, then that should have been a catalyst for a huge move lower. And so again, it was the basis of what the market didn't do as much as it was what it did do. So instead of going lower, what it did was it grabbed a little foothold here and started to go back higher again. And now I've been trading long enough where all of the sirens were starting to go off, where the market wasn't doing what it should have done if it was really a bear market. So you can see it dropped under this neckline, this long-term line at 113, and then it dropped. So if you anticipated this drop and started selling, you were successful for a while. But at some point it stopped going down, and buried within this little price pattern, may be hard to discern it, you had this mini double bottoms where prices hit the same area and they look like that. Now, typically they're a little wider and they look something like this. But if you look at this area here, this is an area where it hit twice. And then you could see all of these days, the market tried to go lower. Every day they try to push. And it was like pushing on a string. It's like it just couldn't push this thing lower. At a point where it looked very bearish, and then you curled up, and this is where all of the flashing warning signs were going off. Like, this is not acting like a bear market should act. And I was then thinking in my mind that we have laid the conditions for a giant trap, that anybody who sold underneath here in the expectation of lower prices is now trapped. And we call this a bear trap. All of the bears who are chasing these lower prices, now if they don't get out, they're going to be trapped when the market goes the other way. And when these traps are uncoiled or sprung, they get unleashed, in a big way the other way. So it was this setup on May 25th where I thought, this is not performing the way it should. It had a rounding bottom. And then we had this little, what I call an inside day bar. You can see the range. And again, this is a daily chart, which means that each one of these bars represents one 24-hour session. I'm not looking at a 5-minute chart. I'm not looking at an hourly chart. I'm not even looking at a 4-hour chart. The reason I look at the bigger time frames is that I want to take the bigger moves out of the market. You cannot be successful, darting in and out of the market like a squirrel hunting for nuts, taking 7 pips here, 20 pips there. You just can't do that successfully. And frankly, I don't see any point in it. If the market's going from 120 to 180, why do I want to take $1 or $2 out of that trade, every couple of days? I want to, take a piece of the middle out of something like this. And so let me just explain what I mean by an inside day bar. So you can see that this range from high to low literally sat within the range of the prior day from high to low. Now, the way I kind of look at these inside bars is that, to me, this is storing of energy. Now you can see it just didn't make any progress over the low or the high that day. So it's like, it's a coil, it's a beach ball. So the metaphor I always use is that, picture if you put your hand on top of a beach ball and you try and place it more and more and more and shove it more and more out of the water. And then you lift your hand, off that thing. What's it going to do? It's just going to uncork. That energy is just going to uncoil. And that's exactly what you saw here, where once it got above here, it just uncorked to the upside. And it was in these 3 days that I made 1.2 million based on the observation of this uncorking or uncoiling. So I use a collection of patterns and price action, and I'll explain that over the course of the next couple of days to get me closer and closer to, a risk reward trade. And to me, trading is all about understanding your risk. And I think this is where a majority of traders, there's a giant kind of myth and misunderstanding. Most traders think, if I could just get in the right place, I'll be successful. And if I get in the right place, then they start thinking, well, how much am I going to make? To me, I think about trading in terms of how much I'm risking. And if I can get comfortable with how much I'm risking, then I'm going to let the rest of the trade just take care of it, where it's going to go. How much is it going to go higher? When is it going to go higher? These are unknowns. These are, unknowns that I can't control. What I can control going into the trade is my risk. So this is where I sent out an email to our members to put a buy stop just above that high at 120.5 on May 25th. So when I started buying this thing at 121 right here, this was my understanding of my risk. So while it looks like a risk, like a crazy bet to put all of that money on the trade, this is all I was risking. If this thing had kind of gone down through that, I was gone. I was out. And so I was willing to take this much risk for that much upside. And so can you see now, most people are trading for very small outcomes. So they're trading 10 pips in the market. If you're trading Forex, 20 pips, what have you. And, so if you're, trying to take 15 pips out of the market, you're probably likely you have to risk 15 pips. Then you're also giving up 2 or 3 pips to your broker. And this is a 1-to-1 correlation, meaning that basically you are having to risk as much as you are going to gain on that trade. And this is why people are not winning consistently, because if this is your betting setup where, if you're risking 15 pips to make 15 pips or 20 or what have you, you're closer to 1-to-1. So now you got to be 90% correct on all of your trades, to win over the long run. Whereas, I, look at my trades, I try not to put on a bet unless I have a 3-to-1 correlation. So in this case, I was looking to bet about $4. And so right here was a $4 risk. So if I'm going to, bet $4, then I want to, make at least 12. So my outcome is 3 times my risk. And if you can set up your trades, and in a Forex analogy, let's say I'm going to risk 50 pips. I won't put on a trade unless I can make 150 pips on a trade. I will not put on a trade unless I can make 150 pips. Again, a 3-to-1 risk reward correlation. Now, the math will show you that you can lose 72% of your trades and still be a winner if you have this kind of risk reward outcome. So again, this is another one of the myths where you're asked, every day to buy some Forex system with a 90% winning ratio. And you think, wow, if it wins 90% of the time, it's got to be great. And if I told you I only win 30% of the time, you'd say, nice to meet you, Mark. See you later. And I make way more winning 30% of my trades than these systems that pretend to make 80% or 90% and then eventually crap out. It's not the amount of your wins, it's the quality. So if I can risk $4 here to make $30 in 3 days, can you see how very quickly that risk reward relationship is going to, be so much more favorable to you? And so to me, trading is about understanding risk. So when I got into this trade, I was so excited. I kind of felt that this was turning, and I felt the risk reward at the time I did it was so favorable that I was willing to make that bet. And so it was getting comfortable with the risk. And then where it went after that, in what time frame, I had no clue. And frankly, it was the same thing this weekend where I sent out the email yesterday and I, said for the same reasons, I think this market's turned. I think it's going to go a lot higher into this white space. And so I'm always looking for a way to, join that trend. So it's all about where do I hop on board the momentum, and how do I calculate my risk? So the way I do it is, again, looking at certain, what I call price action. And on Friday, we had something called a key reversal, where you can see that on Friday, we made a new low, but by the end of Friday's session, we closed on the high. So I use a combination of these inside day bars and these key reversal bars to, join or find a way to get in sync with that trade. So when I sent out my email, where was it? Yesterday, this was the email. This was the setup. No, sorry, this was the email. To put a buy stop at 150, and you can see that the key, I was talking about BYD has formed an inverted head and shoulders bullish price pattern with the appearance of an upsloping neckline. I'll explain that in a minute. Penetration above the neckline will likely be followed by an explosive move higher. Let's see, I would suggest buying the stock that if it opens above Friday's key reversal bar. So what I was saying was now, I look at, most things in terms of price patterns. Is there a pattern that is directing the traffic? Is there a pattern that is now gives us an insight as to what the long-term trajectory is? So in this time frame, we had a double top that was basically telling you this thing was going lower. And now in the more immediate time frame, I see another pattern in the form of this inverted head and shoulders. It's just an upside down looking head and shoulders. And that is a reversal price pattern, meaning that prices leading to this were going down. And if prices are going to reverse, they're going to go higher. So this is a reversal price pattern. So now I see a pattern that is now telling me where the next direction or trajectory is going to be. And now I wait for a day or a set of days where I can now find a high quality trade where I can figure out where to get in on this trend and also how to calculate my risk. So in that email last night, I said, put a buy stop here. So I basically require the market to confirm what I'm looking at. And when the market opened today, it opened a little lower and then went lower. And if it continued going lower, that buy stop, which is just a pending order, it's called a resting order, it won't be triggered until prices shoot through there. So what happened was earlier in the morning for about an hour, and I was on with Peter, my marketing partner in Bangkok, because he got on this trade, and we were watching it. And it just went lower for an hour. And then about 2 hours into the session, it just peaked up and then went through and triggered my trade. And now I'm into the trade. So, I'll be talking about this 4-step process where at the end of all of my subjective analysis, I ultimately require the market to confirm. So here was the email that went out last night. Put a buy stop here, put your stop loss at 144, and the take profit was 181. So this was my risk, and that's my reward. So can you see if you create these setups over time, even if you're wrong a bunch of times, you only have to be right, less than 30% of the time to, be a winner in the market. Whereas the other way, if your expectancy is too small, you have to be a winner all the time because you have to overcome the broker spread. You have to overcome all of the inevitable losses, and you simply can't do that. That's not my opinion. Just look at the statistics. It's estimated that 90% of people certainly in the Forex market are losing. I think the statistics probably bigger. And I think, there's probably all kinds of reason for that, but it's all about expectancy. So if your expectancy is too little, if you're trying to get 10 pips out of a trade or 15 or 7, you simply don't have a big enough expectancy where I'm looking for a minimum of 150 pips, or I don't trade. Simply won't trade unless I can. And, if you go to my review website, a lot of people say, before I met you, Mark, I never made 100 pips on a trade. I know that because that's the way this industry is set up. It's, they've got these expert advisors that, show you there's some kind of magic or wizardry in a box that you can buy. And you'll see their average expectancy is like 3 pips on a trade, which you can't do if the broker's charging you a 2 pip spread. And then most people are trading mechanically using some kind of mechanical, moving average crossover on a 15-minute chart, and then trying to snatch, 20 pips here and there. And what I'm saying is with a 20 pip outcome, you're never going to win. So what I'm looking for is a $30 move on this. I made, $1 million right there because my expectancy was, I bought a $1 call and made $23 on it. You simply can't make money in the market trying to snatch $1 or $2 here and there. You need these broader moves. And the market tells you which way these moves are going to occur. So when this did a double top at 170, it went all the way to 100 after that. It dropped by 70% after it showed you that pattern. So what's the point in trying to take $1 or $2 out of a market that was going to cough up $70 in one direction? And now I think this is going to go $70 in another direction. So why would I just be in this market for a $2 bet? So I got in today, and you can see it only closed about $1.50 in my favor, but I'm still in this trade. So now I think it's even a better trade where you could put a buy stop above today's high, which was 153.43. And I would do that. I would put a buy stop tomorrow, put your sell stop somewhere here. This is your risk, and that's your reward. So I just use the market's action to create these risk reward trades. So Eric says, what is a pip worth and how much is 1 pip worth? I'm not going to get into that. I'm going to give you a calculator where you can calculate your pip size as well, the value of a pip, as well as calculate your risk. And I'll do that probably tomorrow, Eric. So Yadranko said, what market is this? So I purposely took it off there, right? So this is a stock called Beyond Meat, BYND, Beyond Meat. And I purposely took the ticker off here because, that way you're much more objective if you don't know what it is. But the ticker symbol is BYND. It's a NASDAQ stock. It's been a carnival ride up and down, and I've been playing it. But what I'm trying to show you is price action, that no matter if you see this on a corn chart or the euro yen or whatever you want to trade, this is how I evaluate prices in the market all the time. So let me give you one more example, and then I will take some questions. So that was BYND. So recently, kind of amusing and maybe not so amusing story. I went to have surgery in New Jersey, January 26th. And purposely I had to shut off my machines. I didn't want to, stress myself out. I was in my hotel room and I saw this trade and I said, I can't not trade it. I don't care. I've been looking at this trade for 3 months. I told my wife this has one of the best risk, one of the best trading setups back in January. I was looking for this thing. I was waiting, and then it revealed an opportunity. It was in the stock of Lyft, ticker symbol LYFT. And it was end of January. Actually, it was like February 28th that I saw this trade and sent out an email to our members with a buy stop in LYFT at 45.83 with about a $4 this was $1.10 stop loss. I had an initial take profit of 65, and then I moved it. And this stock went from $45 to $65. I said Lyft has formed a massive double bottom price pattern in the near term and the multi-year time frame. I said a penetration above today's inside day bar will likely result in a huge thrust to the upside. I said I am personally long Lyft common stock and the $46 call options, and I was also long the $47 call options at the time. So I was buying it at $45, and my stock, it's not like FX where I can show you where I bought, where I sold, and the profit. All I could say is I got in Lyft at $45 on the 1st of February here. You can see all of my trades. I bought about 7,500 shares, at $45, worth over $300,000. I eventually made $90,000 on a $12 move in the stock, on the stock. And then I was buying these $46 calls at 92 cents. And you can see I unloaded them for $7. So I made 760% in 3 days in that. And then I was also buying the $47 calls at 110, and I got rid of those at 6 and made a 454% profit in 3 days. All on my observation of the trading action in the stock called Lyft. Ticker symbol LYFT. And again, whether it's Beyond Meat, the Euro Yen, Pound New Zealand, whatever you want to talk about, it all starts with a central premise. Is there a direction or a chart pattern so this is a weekly chart of LYFT, Lyft. And, at the start of the year, I knew I wanted to kind of, clean out all the old technology stocks that I'd made money, in the year prior, Apple, Amazon, what have you, and looking for new ideas. And I saw this thing and I told my wife, this is like the best looking thing I've ever seen. And at the time, Lyft was nothing. It was like the second, cousin to Uber. Nobody was talking about it. It had sunk to, like $20 during the pandemic. And it looked like, it looked terrible. But for me, this is all I saw. Beauty's in the eye of the beholder. Made a new low. It bounced off the low. It retested the low. And then when it came through the neckline, which is simply a line that is drawn through the entirety of the pattern, this to me right here represented an amazing buy. So all I look at is a picture. I'm not trying to study, how many ride shares is this company doing? What's the laws in Los Angeles that are, negating, ride sharing and what have you. All I'm looking at is this double bottom, this W price action. That's all I saw. When I was looking at this in, December and January, I was saying to my wife, this just was like, I got so excited about it. And then it broke through and then it kind of went to sleep here. You can see this is a weekly chart. So for about 6-8 weeks, it did nothing. And then it sold off. And so if you're trading a 15-minute chart, this sell-off would have looked like, that now this thing's heading down. It looks like a down move. And, so what I say is that you need to understand the cards that you're holding. And you can't do that if you're looking at a 15-minute chart. You're only seeing this thing crashing. You're not standing back and seeing the huge bottom that is guiding this thing. And so I call this a governing price pattern because this W bottom is going to govern and dictate the prices of Lyft for the next few weeks, months, and possibly years. So this is my cheat sheet. This is my trading for dummies. The markets go through all kinds of phases, but this stock is going to go there. How do I know this? By this. If a market's bottomed, then it can only do what? It can only go higher. And so the question is, when it's going to go higher, by how much, that part I don't know. But by understanding what's happening in Lyft, if it sells off again and I see this double bottom, I know to get long. Just like I knew to get long right here. So this is where I bought it. Now, right there, if you're looking at this weekly, it's like, how in the world can you load up and, take this much risk, from your hospital bed? This was the best setup I would seen in a long time, because effectively what happens is when you see these patterns, the market breaks out of these patterns and then they return and they retest it. And then if it makes a new high, then this thing is gold. So the market gives you all kinds of information. You just need to know how to read it. And again, I'm not looking at the news. I'm not looking at US Federal Reserve policy. I'm not looking at, deficits. I'm not looking at stimulus spending. I'm just looking at this picture to make risk reward bets that I've made nearly 7 figures on. So Azar says, is this actually live? This is actually live. I don't understand why it's such a difficult concept to understand, but so this is the live chart. I'll just bring you over. So this is my live broker platform. This is, my personal broker, and this is Lyft. So it was in this time frame. Let me just go back a little bit more. Okay. So now we saw the weekly stock, the chart of Lyft. I'm using these different charts because the bars are spaced a little bit better apart. And I think it's actually, I know this is probably harder to see. I just want to show you that this is live. All right, so I think this is easier. It's a more robust or brighter platform. So yeah, I can make my same point here. Let me try and space this a little wider apart. There we go. All right, perfect. So this is the live real-time chart of Lyft. This is what happened all the way till today. You can see it closed right there at 58.5. But here is where I did my trade from a hospital bed in New Jersey on January 28th onward. So I showed you the double bottom here, where you had the one low here and the other low. You had this huge double bottom on the weekly chart. So this is what told me that this thing was going to go higher over time. And so here was that point on the weekly chart where you saw, all of this resistance, this rounding top. And, if you just looked at this portion of the chart, maybe you would speculate, this is a rounding top. You can make the case that maybe there's a double top here and this thing's going to go lower. And that's why, looking at the longest time frame possible really gives you a heads up on, where it's going to go. So on the basis of that large double bottom, which told me that the market's going to go higher over time, this to me, this sell-off represented a remarkable opportunity. And it was right here where I saw this little double bottom here. You can see where you made two lows right there. And I, was already thinking that was the low, and I just needed additional confirmation. And so here was that email that I sent out. Let me just go back to the email. Just, so this is what I was looking at the time, without any prior information. Here was the buy stop at 40. And I said, penetration above today's inside day bar will likely result in a huge thrust to the upside. So the inside day bar was right here. And again, the definition of an inside day bar is you can see that bar, the high and low of that bar sat within the high and low of the previous day. So we call that an inside day bar because the range of that bar literally sits inside the range of the prior day. And again, I just look at those days as a coiling of energy, just storing of energy that's going to unleash and uncork in the direction by the prior trend and pattern. And so this was my email. And this is where sometimes, the risk really gets reduced in the market, because I said to our members at that time, put a buy stop here, put your stop loss there. So this is your risk and that's your reward. Now, can you see, if you set up your trades like this, how it doesn't take a whole lot to start, adding to your account? So commensurate with buying the stock here. So I was buying the stock there, and then I was buying the $46 and $47 calls right here for $1. So that means, when the stock was at 45 bucks, this thing had to go to 47 by the end of the week for me to make money. And it closed at 53. So the calls that I paid $1 for, I got out at $7. I made 700% in 3 days on that move. And now we understand that Lyft is only going to go higher over time. So now you want to keep buying it. So you can see, here's your key reversal. Here's your little inside day bar. And all you had to do was put a buy stop above Friday's high, and now you're into this trade. And so this is going to keep going higher. How do I know that? The pattern tells me. So I think, basically I'm going to end it there. We spent like an hour, and I'll take some questions. So this is not a bot. Bots will not make you money. So ask yourself a question. You go on the internet and somebody says, I'm going to sell you a robot for $300 or $600 or $900, what have you. All you have to do is put it on your MT4 trading platform, let it trade away for you in perpetuity, sit back, and it's just going to make money for you. Does that make sense? I mean, just intuitively, yes, they're going to show you all of these track records and, trees going to the sky. And if you compound this, and that's the thing, they show you a compounding rate that if you kept on compounding your money at that rate, you would have more money than the US gross, domestic product. Does that make sense to you? And guess what? If they could achieve that, do you think instead of selling it to you for $600, that Goldman Sachs or JP Morgan wouldn't pay that developer $10 billion for that? So if that makes sense to you, go and buy those things. I don't know if this does this make sense to you guys? So if you want to give me some feedback, I've just been talking for a long time. I have no clue how you guys are digesting this. Do you see that, does this start making sense to you? Did you see how this, so Lindsay says, this has been very helpful. Lynn says yes. Richard says yes. Wayne says your words are gold. So yeah.
So Carly has a question. Her understanding was a price pattern would likely go in the direction for a year. However, Beyond Meat has proven that this statement is weak, or is it just an exception?
So, we don't really, that is the beauty and the difficulty of trading. When we see these patterns, they give us an insight into direction. For how long, how much, that's always the constant thing. But, for instance, like Lyft, that double bottom, I think that is telling you for years that's the bottom. You'll never see $20 in Lyft again. And so it just suggests to me that this will go up for years. Now, does it go up straight? No. You can see that we have these sharp, sell-offs. This thing could go sideways but eventually, it will then head north again. So I'm always looking to get in sync. Now, obviously, the further away the pattern took, the less, impact that it has as it grows. Then now new shapes and new patterns will take place. So it was just like the double bottom is here, this double bottom is here, and I knew I could get a ride here. Now what goes on in the next time frame, then it's just a function of looking at that setup. Beyond Meat is a whole different, Beyond Meat is a circus ride. It's a whole other thing. And to me, I probably shouldn't have brought it up. It requires, I guess, a little bit more sophistication. And to me, it was Beyond Meat was not only what is happening here, but what didn't happen here. This should have gone off a cliff and it didn't. And by not going off a cliff, it tells me that this thing's just going to go a lot higher. I can't explain it.
All right, so Russell's asking, how do you find these potential trades when there's thousands of stocks and currencies? I understand you see.
So that's a good question. It's something that, I get all the time. So here's a site that I go to. It's called Finviz. I'll put this in the, and I literally will spend, hours going through hundreds of pages, just, going out, looking at symbol after symbol to find a pattern or something. So this just gives you a general, winners, losers for the day, but then you can actually go into the screener and you could put, the NASDAQ, what exchange you want. Do you want a certain market cap, 2 billion to 6, and then you can put in your parameters and you can see there's 29 pages of just different symbols here. And I will go through every one to try that one needle in a haystack. Then every day you have an earnings calendar. So this is a pretty light calendar with no major stocks. So every day you have, so tomorrow, these will be the companies that will announce earnings. So you have H&R Block, a big company, Lazy Boy. And so I will just go into the symbol, and sometimes I will trade a symbol, LZB. I'll actually, look and see if there's an opportunity to get in before the market will, announces its earnings. So you can see that, we've got a key reversal, going into tomorrow. I'll kind of, check out the history here, and I might just, go short this into earnings. Now, that's a very risky thing. I mean, earnings, you can get a move up or down 20%, but that's kind of the beauty. You get, so let me just see what this looks like. So LZB, this is, something that I wouldn't trade. It's just going sideways. It's sucking you in, but this is going to announce earnings. Tomorrow, after the market, something's going to happen in this stock, up or down. And so I will just go through all of these symbols, and whether it tells me to, trade that now or down the road, I'll just put it on my list as something to watch. So yes, there are tens of thousands of, shares out there. It can kind of drive you crazy. You can see that I've got, dozens and dozens on my screen here. I kind of, look for opportunities within those names, etc. So Minnie says, what analysis time frame do you use? So always, a longer term time frame, Minnie. So either a daily, a weekly, or a monthly. And again, why do I use a longer time frame? It's because I want to make the bigger money. I'm not, interested in a 15-minute chart, right? So if you look at BYND, and let's say we drill it down to a 15-minute chart, what does this tell you? I mean, this actually looks like a short, right? I see the double top here. I see all of these tops, and based on this 15-minute chart, I would likely go short here. In the meantime, I'm heavily long. So you need to see the forest for the trees, right? And if your intent is to trade Beyond Meat for another $1 or $2, and be my guest, trade this on a 15-minute chart, but you would never have made the 1.2 million that I made, in this explosive move higher, where you can see that I got in right here in this inside day bar at 120, and 3 days later, it went to 155. I would never have seen this on a 15-minute chart. Aaron says, which broker to use? I don't really disclose brokers. I'm not a money manager. I'm not a signal provider. This is an education service. I don't endorse brokers. They don't endorse me. This is a very regulated industry, so I'm not trying to dodge the question. You can go and find any regulated broker out there that will give you these capabilities. I'm not using any magic at all. You can see this is just a very rudimentary chart, high, low, close. It doesn't matter where you find these charts. There's many free services. Barchart.com gives you free access to, bar charts.
Hey, Mark, so if you're using a buy stop, where do you put your stop loss?
So again, the placement of the stop loss and take profit is always kind of a difficult one, not because I try and, duck the question, is because every trade is different. Every situation is different, but, some trades are more, and the trades that I find that I'm very successful are the ones where I understand where the risk is, and the risk is very small relative to the reward. So in this case, the entry was there and the exit was right under that low. And I would do the same thing tonight. So I put a buy stop here at 153.5. And sometimes what I do is I'll use the unchanged, the previous day's close, as some kind of barometer where I'll put, stop loss, somewhere, sometime, out of, the other side of unchanged, but you could still get cut up by the noise. So, just to be safe, I would put it under today's low. So I put a buy stop there. This is your risk, and I think you've got an enormous reward. I think this thing goes north of 180. So every trade is, different, depending on where you get in. So yesterday, the buy stop was there at 150, I think it was, and then my stop loss was at 144. And then I would just leave that stop loss, even though it made some money today. I'm going to leave it in the same place. I don't want to get cut out by some arbitrary noise tomorrow before it takes off. So I'll leave my stop loss in the same place. And then my take profit was here at 181. And if this starts making a move up here, I'm going to start moving this out of the way. I'm not going to stop it from making me more money. So Ruth says, with the inside day bar, sorry, it's scrolling so fast. Does the shadow also need to fit? So I don't use candlesticks, but to answer your question, Ruth, I don't really care where a market closes on an inside day bar. So, let's say, this market, instead of closing on the high of the day, closed in the middle or even the low. I just would have seen that as an inside day bar. I would have put my buy stop here no matter where it closed. And, if it went further down, then your buy stop's not triggered. And that's the beauty of a resting order. The market just confirms what you're looking at. All right, Dwight, is there another question?
Yeah, so Humphrey's asking, how do you know, sorry, as Manuel, what's your trigger to exit a trade?
Well, again, that's, dictated by the shape of it's so the pattern tells you where to get in, and then the market tells you where to get out. So this pattern basically double top told you that this thing was going down. And then this is where the market stopped going down. So very often, I'll look at the price action, what I call it, these key reversals. So right here, the market made a new low, but it closed on the high. And then you had this price action here, this double bottom. Now, I sent out an email probably a month ago where I was shorting Zoom, Peloton, all of these stocks. And I thought they were going to be Beyond Meat. All of those I was shorting at the same time. And I thought all of those stocks were going to continue much lower than they did. So this is a great example. This is Zoom, ticker symbol ZM. And based on the prevailing chart patterns, I was short this stock and made just a ton. So you can see here's a double top here. Here's a head and shoulders. So this was my governing price pattern. So this bearish price pattern, this double top, the head and shoulders, told me that this market had topped. And so you saw when it topped, it went from $588 to $275. So that pattern dictated that move, in that time frame. And frankly, when you made 8-month lows, just like Beyond Meat. So by virtue of what this market didn't do, as much as what it did do, it started sending off all kinds of alarm bells to me. So you can see right here, we broke an 8-month low right there. And I thought, a breach of this neckline was going to set us up for, a huge move lower. This was actually my expectation. And so, whatever I think doesn't matter. It's me. I surrender to the will of the market. And you can see right here, market made a new low and then closed on the high. Now, sometimes you get those things, they're fake outs. You never know how to, interpret them. But here you saw a double bottom where it did the same thing. It made a new low and closed at the high of the bar. So now you see these two key reversal price action, in the same area. So now you have this double bottom. And just like Beyond Meat, once you started getting above this breakout area, all kinds of, now this is, when something doesn't, go according to, what it's indicating, then it's going to do the other thing. So it doesn't sound terribly smart, but if something's not going to go down, it's going to go up. And that's exactly what's happening here. So now this formed another shape where, the double top and the head and shoulders were dictating this move. Now you've got, an inverted head and shoulders. And today you've got this inside day bar, same kind of coil where you've gone up and then you've got this little inside day bar. So my expectation is, tomorrow you're going to get some trading action out of here. Now here is where it gets very tricky. where, is this, inverted head and shoulders now kind of, suggesting that we're getting a new move? Or is this just a counter trend move within a, long-term, downtrend? And this is where it just gets a little bit tricky. Sometimes there are no definitive answers, and you just got to take the path of least resistance and set up your trades and see what the market's going to do. So frankly, I would put a buy stop here, a sell stop here, and see what the market's going to do. And the nice thing is, you're not risking a whole lot, but with an inside day bar, a small range, so that's your risk. And, that could be your reward. Still another $50 to the upside. So it looks like we're going to get another push out of here. And so that question is, the market puts me in. So right here, this double top put me in the short side, and this double bottom put me in on the long side. So the market puts you in. And so these patterns, when they end, how they end, the market will put on a pattern and price action that you can typically read into. So a lot of people are referring to these as candlesticks. So this is what's called a bar chart. Now, nobody really uses bar charts. I've just been using them and I just visually. So when I look at a combination of pattern. So right here, you have what looks to be a double top pattern. So just visually, that pattern in and of itself is, something that I see. But then I look for confirmation in terms of what does the price action. I call this kind of the quality of the bar. So you can see visually, this made a new high, and by the end of the day, it closed on the low. So when I look at these bars, I can see these bars clearly. With a candlestick, I'm sure if you're used to it, so made a new high, close on the low. So when I see those just stand out to me. Made a new low, close on the high, made a new low, close. So I just see bar charts very clearly. This is a bar chart where this is what a bar chart is. Sometimes I assume so much. So every day you have a high, low, or close. And either it's going to, if it closes closer to the low than the high, after making a big range, this kind of tells me that it's a key reversal, meaning that it went higher, at some part of the day or week, and then close on the low, leaving the sellers in control. Now, I don't just look at these bars in a vacuum. I don't say, oh, here's a key reversal. I'm just going to short it or I'm going to buy it. I look at it in connection with the trend, the pattern, and things of that nature. And then an inside day bar would look something like that, where literally the range from high to low of that bar sits within the high and low of that day. And sometimes the combination of an inside day bar and a key reversal, then basically I would just sneak a sell stop under the low of both of these. And that's gold if you get triggered. So you don't need both, but when you see both, it just gives you more confirmation. So I look at bars. I don't look at candlesticks. And then I wait till the close, because the close tells me relative to the high and low. So you can see on this particular day, buyers were all, it opened up there. But by the end of the day, it closed on the low of the day. The sellers were in control, and it actually pointed in the direction it wanted to go. So these bars, they actually point where the market wants to go. You can see here was another double top with this key reversal. And after that, the market went $100 lower. So Ellie says, how can I join your daily email list? We're going to be doing this for the next few days. If you want to know how to join, just send a message to support@thepatterntrader, and I'm sure somebody will get back to you.
All right, Mark, another question. Do you ever market?
Are we going to be playing a video today, Dwight?
Yeah, I do have that video.
Okay, so to Ellie, we're going to be playing a video, and I'll probably wrap it up, in a few minutes, and we'll play the video on how you can join my daily my daily lists, and Dwight will tee up a video and tell you exactly how to do that.
Okay, so how do you know which direction the market will go in after seeing an inside day bar?
It's dictated by the pattern and the trend. So I don't use an inside day bar or key reversal, in a vacuum. In this case, you have a pattern that is emerging. It broke above this neckline. And so now you have an inverted head and shoulders. So now I don't just look at this, wow, this is an inside day bar. I'm just going to buy it. I'm looking at this as a bullish price pattern, meaning that the market is likely to go higher. Next. So Yannick says, how do you define the neckline? So you can see neckline is simply drawn from the beginning of the pattern to the end of the pattern. I mean, this is kind of extraneous here. So it's just the whole entire pattern is connected by this neckline that's drawn through all of these connective highs. You can see in here, the neckline through this double top would be really through the lows of this double top right there. That's the neckline. So it's basically a line that's drawn through the entirety of the pattern.
All right, so is there any rules for moving the stop loss higher or lower?
It's just based on market action. I'm not going to really get into that details. There's no definitive rules. It's based on what once I kind of see, I put my buy stop here and then I see how the market's going. Like I said, with Beyond Meat, I have a take profit at 181. If that thing keeps moving higher, I'm just going to keep moving it out of the way until the market tells me that it looks like there's resistance or it wants to turn or what have you. There's no set answer for the placement of stop losses and take profits. It's based on where you get in the trend. So, let's say, I had an order, an email to get in right there. I would put in another email there, but let's say now we're up here. Now the market's at a different maturity than when you got in here. So the take profit and the potential would start to be a little different as these resistance areas start creeping in. So sometimes there's a normal resistance in the market. There's different areas. There's no, one size fits all answer for that question.
All right, why do you buy the stock and the calls and not the calls only?
In the case of Beyond Meat, and okay, so I was just really horny to get into this market. I had a feeling what was going on here, that this thing was compressing. And so you can see when this market closed this inside day bar, I kind of immediately knew what was going on. And sometimes I will start buying stock in the pre-market session. So the stock market opens, the regular session opens at 9:30 a.m. But from like 8 a.m., like an hour and a half before, you have a pre-market session. The market is trading. And we're actually going to be introducing a pre-marketing package. I'll talk about that at some point. I was able to start buying this stock at 121. You can see it actually opened around 123. This left hash mark is where it actually opened for that session. But I was buying my stock at 121 in the pre-market session. So you're not able to trade options in the pre-market. You can only trade, the stock. And so I started acquiring the stock in the pre-market. And then once the market opened, you can see it opened, then dropped lower. And I just then started buying the options on top of that. So options are just a lot more leverage and they expired. So the options that I bought here, they expired 3 days later, where stock you can hold forever. So I wanted to kind of, have both, where, you have the leverage as well as the ability to stay with the stock, much longer than these short-term duration options. So the calculation is very subjective. It's based on how you feel. It's how excited you are about the market, things of that nature. But, you can also lose. I mean, today, I'll show you that I was losing a whole bunch of money on, where are these things here? I was, losing 10 grand on these options. I bought these put options on this ticker symbol RUN. I ended up getting out. I got out for 25 cents. I lost over $10,000. So you can lose a lot very, very quickly in options. And so the calculation is, it's based on timing and also cost. So right here, I was able to buy these call options for like $1. The 125s and one, whereas now, because the volatility's increased, the call options are more expensive. So for the same calls that I was buying for $1, it now would cost me like 3. And when I buy puts or calls, I want to make 3 to 5 times my money, because most of them, like you just saw, I'll lose 50% or 100%. So you need your wins to be much bigger than your losses. And so now if I'm paying $3 for a call, I need that thing to go to $15 for me to make, 3 to 5 times my money. And look, I think, Beyond Meat is in one of those modes where it's going to go again, where it's going to go up big again. And I kind of felt like I should have bought calls, but instead I loaded up on the stock. And now the stock, lets me, wait. I don't, the call options have a certain expiration if the price doesn't go there by that time. So with an option, you have to be right, and you have to be right now. And I do think the timing is right now for this. So in a way, I was looking at buying these calls on the close, and I just couldn't. I mean, I have like 20,000 shares of the stock already. So if it goes up, I'll be nicely taken care of. But I would like to have the calls, and maybe tomorrow I will. If this thing opens lower tomorrow, I will buy some call options, because I think that there's nowhere else for this thing to go but higher.
All right, Mark. So Nana is asking, do you always trade pure price action, or do you sometimes look at moving averages?
The former. Only look at price. Look at this chart. Everything you see on this chart is what I made $1 million with. Nothing else. In fact, the volume below here, this volume stuff, I don't look at it. I don't look at, when I was buying it, volume spiked and it was, declining. I don't even see that. I don't take that into account at all. All I look at is this picture. That's all. That's it. It's called a clean or naked chart because there are no indicators on here. I don't look at Bollinger Bands, moving average. I don't look at anything other than exactly this is all I look at. And then I make risk reward calculations off that. And that's really what it's about. It's about risk and reward. And to me, it's if you know your risk. Most people think about entry. If I just had the best entry and, when they get in, how much am I going to make? To me, it's a question of how much, am I going to lose? And if I'm comfortable with that, so I know if I get in here and this is my risk, that was my risk today. So now if I know that this is my risk, where this is going, how much, when, I have no clue. That part I can't control. What I can control is knowing when to get in and, where my risk looks very comfortable. Getting in here and risking that to make that is, what I will do every day and then Sunday.
All right. So here's probably a tricky one.
So last one, Dwight, we were, hour and a half into it, and then you're going to play the video. So I'll take one more question, and we still have 4 days together.
All right. All right. So this is from Jose. Using a bear governing pattern on a bear key reversal followed by an inside day bar, does a bullish inside day bar negate the bear key reversal trade?
No. I don't really care. I don't really care where, this closes. An inside day bar, it doesn't matter really where it closes. If this closed on the low, I still would have put a buy stop here. And guess what? If the market just kept going lower, then I'm not triggered. But if it closed on the low and then went that way, then I don't really care where it closes. To me, it's more what was, so the inside day bar or the key reversal are just a component to get you in the direction that's already indicated by a prior pattern. So here was the pattern that was the catalyst. It was like this rounding bottom and this double bottom. So by the time I got in here, this is why I was getting in. It was kind of the trap. It was the breach above the neckline, and then this rounding bottom. So this is just a way to, so once I see a direction, I see the pattern, then I wait for a day or a set of days where I can get in, where I can join the trade and understand my risk. So, everyone talks about the holy grail of trading. So if I told you where, to get in a trade and what your risk is, that's about as close as you're going to get to the holy grail. It doesn't assure that you're not going to get your stop taken out. But if you know where to get in and what your risk is, that is the holy grail of trading. Genevieve, you're welcome. All right, one more question, Dwight. I could be here all night, and so I got to just one last question and then play the video, Dwight.
All right, let's do this one from Ben. Would you always wait until neckline breaks or as it forms a second shoulder?
No, I'm pretty aggressive. I can start seeing these patterns, start forming in, in my sleep. And, it's like, frankly, once I see one bottom and it's coming here, I already, know that I'm going to start buying it there before it's even gotten there. So if this thing starts coming here, I'm going to start buying it right there. So if I saw, certainly, some price action here, and then if you gave me another one, I would buy it, right there. I mean, the neckline's up there, but I would be buying it, very aggressively right here. Because again, it's understanding your risk and reward. If I could get something like this where, I could put my buy stop here and put my sell stop there before a market turns, you can see that I've got so little risk for so much upside. So I'm pretty aggressive because I'm pretty good at seeing these turns and understanding when it's going to turn and looking at the price action. And like I said, even if I'm wrong, the greatest thing is when you get a turn, if the market kind of gives you one of these, and this is a turn, and you can get in here and risks are there, your risk is so small relative to if you're right. So, I don't wait until the confirmation of a neckline. No.
All right, great.
All right, so why don't, so Steve says, do you do just stocks? So no, I don't. I apply all of this to, Forex trading I've been saying forever, and we'll talk about this tomorrow. I've been telling our members, and a lot of them will be on here today. I've been saying all the way from here in December, even though this is a sideways trading carnival ride of the pound versus New Zealand dollar, I said right here, this thing is going 1,000 pips higher. And I'm telling you right here, this is going 1,000 pips higher. And I'll talk about tomorrow why. So this is a Forex trading pair. So as I said at the outset, you can apply this analysis to any trading instrument under the sun. If it has a high, low, and close, interest rates, swaps, derivatives, whatever, you can analyze using this methodology of patterns, price action, direction, and layered with an execution plan. All right, I will see you tomorrow, 4:30 Eastern time. Dwight's going to show you a short video on how you can join my email list if you like this. Dwight?
Yeah, it's coming up.
Okay, so can I leave, Dwight, or?
Yeah, sure.
Okay. All right. Thanks, guys.
This is what I focus on. This is known as a clean chart or also a naked chart. And the reason why it's called a naked chart is because you'll notice there are no lagging indicators overlaid on top of this chart. There's no MACD, there's no stochastics, there's no moving average, there's no Fibonacci's. There's just bars with a low, high, and close. Sorry, excuse me. So it's not even a candlestick chart. It's just low, high, and close. And as you'll come to learn, I focus on how a market closes relative to the high and low of that particular bar. So again, what I'm looking to do is target moves where this chart went from 92 all the way to 79. This was a $13,000 move for every $1,000 you put up. And my objective is to take 400, 500, 700 pips out of the middle of a trend like this. Similarly, when it shot up from 79 all the way to 87, that was an $8,000 move for every $1,000 you put up. And again, my objective is to take 300 or 400 or 500 pips out of a move like that. So this may be a little bit redundant for some, but let me share with you exactly what I mean by a bar and what that means. So every trading day, we know that the FX markets trade continuously from Sunday through Friday, but each 24-hour session is denoted by a low to the session, a high to the session, and this slash mark indicates where that session closed. So typically the close is 5 p.m. Eastern, and then some charts it's also represented by at 8 p.m. Eastern. But there is always a session low, high, and close. And I look at the close relative to the high and low. And as you'll notice, this particular close was much closer to the high than the low, which indicates that the buyers won the day on that particular day. Now, I don't just look at a bar in a vacuum. I look at in context of an overall trend or pattern, and I'll explain that in just a moment. This is an indication of a bar where the market went higher, went lower, and then settled much closer to the low than it did the high, again indicating that the sellers won the day within the context of a trend or chart pattern. So now this is my trading strategy. So if I open any of my given instruments, whether it be Euro versus USD or Pound versus Yen, the first thing I'm trying to assess is what is the phase or the condition of that market. And by and large, you've been told that there are only 3 ways a market can be going at any one time. The market can be going up, going down, or thrashing around between a resistance and support zone in a sideways market. But I'm going to add a couple of other nuances. To my mind, the market can also be turning from down to up, or in this case, from up to down. Now, if the market is turning, as I indicated, there will always be what I call a historical precedent or chart pattern that precedes that turn. So the first major chart pattern that I want to share with you is what I call the double top or double bottom. And it's just the way it sounds. So this is an indication of prices that were heading up, hit a resistance point, backed off, hit that peak again, and then backed off. And then when it crosses what we call this neckline, which is simply a line drawn through the pattern, it reveals what we call an M top or a double top. And this is indicative of a market that is reversing from a market that was going up, hit this double top, and then indicated a market that was going down. This is a head and shoulders chart pattern, and it's just the way it sounds. So this looks just like a man or woman's head, left shoulder, right shoulder. And when we cross a line through the entire pattern, it's called a neckline. And I'm going to show you the weekly dollar yen that I recognized this head and shoulders pattern at 124 and was able to short that market all the way to 100 in the dollar yen recently. This is an indication of just the opposite. It's called an inverted head and shoulders, and it's just an upside down version of this head and shoulders, which indicates a market that is reversing for a market that was going down. When it completes this inverted head and shoulders formation, it then indicates a market that is going to shoot out the other way. This is a number of different triangles. The first one is called an ascending wedge triangle. It's denoted by a sloping uptrend line against a horizontal line that connects the highs. On the other hand, this is what we refer to as a descending wedge triangle, a market that was going up, and then when this pattern or this triangle is completed, it indicates a market that will inevitably crater or go much lower. This is just a fancy version of the double bottom. It's called a cup and handle, where we see the cup and the handle. These are a number of different channels. If we see this at the top or bottom of a market, it's either a rectangle bottom or a rectangle top. So again, this is a layered approach. One step confirms the other. And so just because we either identify a trend or a chart pattern, we don't just simply wait in at the market. We wait for what I call an insurance day bar. And this is kind of my own little personal slogan for this particular bar. And the reason why I've called it an insurance day bar is because when we see this particular bar, it actually isolates exactly when the momentum is likely to continue in our favor, and also tells us where and how to place our risk. So what exactly is my definition of an insurance day bar? Well, the first definition is what I call a key reversal. And a key reversal is exactly what it sounds. So this is representative of a market that was stair-stepping lower, the point where there are no more sellers, and then reverses 100 miles an hour and closes in the opposite direction. And when we see these reversals, very often this is where the market is pointing to where it wants to go. So we don't have to be geniuses with an MIT degree in economics to know when these market reversals are happening. The market actually tells you the direction where it wants to go and when it wants to go when we see these. This is another example of a market that was going higher, hits a point where there are no more buyers, reverses and closes on the opposite end of that daily bar. And of course, the larger the bar, the more robust or an indication of that signal to come. And again, this may be, depending on where this reversal occurs, maybe a signal that the market is pointing exactly where it wants to go by closing in this kind of reversal fashion. So again, when we see these key reversal bars in context of a trend or in context of a chart pattern, then we have the beginnings of a high probability setup. Now, my second definition of an insurance day bar is what we call an inside day bar or narrow range day bar. And it's just what it sounds like. So this is an example where the high and low of this particular bar, this daily bar, each bar represents one day, sits within the high and low of the previous day. And you'll also notice that the range from low to high is much smaller or narrower than the preceding ranges of the preceding trading sessions. So this to me represents a coil or a storing of energy. And the metaphor I always use, or comparison, is a beach ball effect, where picture, if you will, you suppress a beach ball underwater, you keep pushing it, pushing it, pushing it, and then you take your hand away. What happens? It just explodes to the other way. And this is exactly what happens when we see the presence of these narrow range or inside day bars in the market. Now, I recognize you're just looking at a cartoon on a page right now, but I'm going to show you on the live market conditions how the markets explode out of these coils all the time. This is an example of a key reversal and an inside day bar where we have this coiling effect, this beach ball effect. And then when we have a release of this energy, we can expect this kind of movement in the markets. So as I said, this is a layered approach, and each step confirms the other. So even though we might have confirmed a trend or a chart pattern indicating a turn in the market, then we see the presence of our inside day bar or key reversal bar, insurance day bar. Then we wait and layer it all with an execution plan in the form of a pending or resting order. So effectively, the pending or resting order requires the market to ultimately confirm our entry point. So up to this step 4, all our analysis, whether it's our analysis of whether we're in a trend, whether we're in a reversal chart pattern, whether we have our key reversal bar, whether we have an inside day bar, this is all our own subjective analysis. And we can be right and we can be wrong, but the market is never wrong. The market is always 100% right. So by using this execution plan, we require the market to confirm our entry point. And then also this resting order also puts us in at exactly the time that the market is ready to go in our favor. And let me show you exactly what I mean. So this would be an example of, let's say we've identified our insurance day bar in the form of a key reversal, where the market opened lower, as indicated by this slash mark, and then went higher and then closed on the high of the day within, again, the context of a trend that's going higher or a chart pattern that indicates this market is going higher. And now we're interested in taking a position on the long side. Again, I don't just arbitrarily get in when the market closes for the past session. I put in a buy stop, resting order, or pending order just above the previous session high, usually by about 1 or 2 pips. So I'm not going to go into a huge explanation of buy stops or sell stops. You can go to your execution orders in your MetaTrader platform, and you can see a buy stop and sell stop there. But effectively, we place a buy stop above where the market is currently trading. In this case, I typically place a buy stop 1 or 2 pips above the high of the previous day's range. And then I put my sell stop just the other side of the close or the unchanged of the previous day's bar. So 2 scenarios can happen once we place our buy stop. The first is the market opens for the next session, drifts lower, and then never recovers. It just keeps on going down, and our buy stop is never triggered. Then I simply just cancel the buy stop 24 hours after I place it, or roughly just before the start of the next session. The other scenario is the market opens, goes lower, and 1 hour later or 2 in the morning while we're sleeping, our buy stop is triggered. And now we're placed in the market at the time and place where hopefully the market is ready to go in our favor. And now we just want to see, obviously, the market to keep going in the direction that we've analyzed it to go. What we don't want to happen is the market goes higher through our buy stop and then starts drifting lower. And then at some point, if it drifts too low, we're going to want to protect our account. And that's why our stop loss is just placed on the other side of unchanged. Hypothetically, we've isolated our key reversal, which is now pointing in the direction higher. It's now been complemented with this inside day or narrow range day bar. Now we look to probe the market in the form of putting a buy stop 1 or 2 pips above this inside day bar high, putting our stop loss on the other side of the unchanged, and then hopefully looking for the ensuing market action that looks like this. This is an example of an order where we may want to probe the market on the downside, but instead of just arbitrarily going short at the next session open, we place our sell stop 1 or 2 pips below the low of that session bar. Again, we're looking for the market to confirm our entry order. And if the market keeps going higher, our entry order is never triggered, no harm, no foul. We just cancel it the next day. Similarly, we put our stop loss just the other side of the previous day's close or unchanged level to protect our account. So just as a quick review, again, this is a target methodology that takes you closer and closer to the bullseye of a high probability trade setup. So again, irrespective of the instrument you're looking to trade, whether it be a stock or a commodity or an FX pair, you first want to identify what is the main phase or condition of that market. Is that market trending up? Is it trending lower? Is it thrashing around sideways? Or does it appear to be turning from bullish to bearish or bearish to bullish? Once we've identified that we might have a market that is in the process of turning, there's always a chart pattern that precedes that turn in the market. Double top, inverted head and shoulders, descending wedge, etc. So even though we might have articulated or identified the phase or the condition of the market or a chart pattern, we don't just arbitrarily wade in. We wait for the appearance of what we call our insurance day bar. And remember, I have 2 definitions of the insurance day bar. One is the key reversal, where we have a washout, the market goes lower, closes on the other side at the high part of the day. Or you have what's called an inside day bar or a narrow range day bar, where the low and high of that particular bar is much lower than the previous sessions preceding that. So now, even though we've seen all phases of this particular methodology, we've articulated the condition, we found a chart pattern, we've waited for our insurance day bar. Again, we just don't wait in arbitrarily. We layer it with an execution plan in the form of a pending order, buy stop or sell stop. A buy stop in a market we're looking to go long, 1 or 2 pips above the previous session high, or a sell stop where we'd place 1 or 2 pips below the session low. So remember again, the first thing I'm trying to identify is what is the phase or the condition of this market. And this is a little bit deceptive because up to this point, the market was heading higher, and we want to be in lockstep with the trend of that market and looking to, take positions that, put us on the long side in that this market is going up. But again, when I saw this market starting to peter out, where all these days it couldn't make any advance to the upside, it looked to me that this market was going from a bullish market to potentially a bearish market. But again, just because I have that supposition, I wait for the second confirmation in the form of a chart pattern. And here we have our double top or our M top. Now the peaks don't have to be in exactly the same place, but when we stand back and take a long view, we can see that this has established a double top price pattern. Now, again, just because I've isolated the fact that we might have a market that's turning or a bearish chart pattern in the form of a double top, I wait for what we call our insurance day bar. And again, I don't know if this is too clear on your screen, but right here, this daily bar is the high and low of this daily bar is within the high and low of the previous day, hence making it an inside day bar or even a narrow range day bar. So then the fourth part of our methodology would be to place a sell stop just under the low of that bar. So these were the trade parameters when I put in this entry order. So my risk was 42 pips, and my initial reward outcome was 159 pips, or about 4-to-1 risk reward on this particular trade setup.
All right, everyone. So that wraps it up. So we'll see you tomorrow at 4:30 p.m. Eastern Time.